My name is John Turk, and I'm with Fiduciary Pension Partners. And if you're here today for the tax efficient retirement planning key strategies for 2026, you are in the right spot. Thank you for taking time out of your day to join us, especially on your lunch hour. We'll just get through some quick housekeeping items and quick commercial here. We are recording today's session, and that will be distributed to you in the next day or so. At Fiduciary Pension Partners, we are a full service RIA shop, registered investment advisory shop. Some of our differentiators include being employee owned and very independent consulting firms. We do not have any conflicts of interest. We're not a bank, we're not owned by an insurance company or a broker dealer affiliation. So for you, whether you're a plan sponsor or an individual, it's important for you to know that there are no conflicts of interest. We serve as your advocates and work only in your best interest. Some of the core services that we offer for both plan sponsors as well as individuals include investment analysis, selection, and monitoring, both at the plan level as well as the individual level. Plan design strategists, and that might involve different types of match formulas. Perhaps it's just a profit sharing or some type of an employer contribution. Plan governance. I can't tell you how many plans that we work with where we're helping the plan sponsor and the members of the committee understand their responsibilities as a fiduciary. And we also provide risk mitigation around that. And then also employee education. We work with plan sponsors setting up seminars, either in a group or an individual setting. A lot of times folks have questions of a personal nature, and we make available complimentary one-on-one sessions. If you have questions about the retirement, about your 401k plan, or about the retirement plan, ultimately, that's a core responsibility for us and a role that we take very seriously. So with that, we're going to bring in Roger Young. Roger, great to see you again, a friend and a great business partner. And just to give you a little bit of background on Roger, he's been in with T. Rowe Price since 2017 in a thought leadership capacity. He's a thought leadership director, and he shares and helps develop and articulate the firm's perspective when it comes to retirement planning, tax strategies, as well as both accumulation and decumulation strategies. Prior to that, Roger was with Wells Fargo Advisors, and even before that, he was with Black & Decker, which is now Stanley Black & Decker. Roger has a variety of degrees, a bachelor's from Loyola University, as well as two masters, one from Carnegie Mellon and another from the University of Maryland in operations and statistics. So Roger is very busy there in those earlier years. So Roger, we know that we don't want taxes to kind of be the end all for folks when it comes to retirement plan decisions. We don't want the tail to wag the dog. So let me bring you into the conversation, share your perspective, your expertise, and maybe do a quick review of our agenda.
Sure, John, thanks. And so it is great to be here. And yes, I think we cover a lot of topics in my group. I seem to kind of gravitate toward the taxes for one reason or another. And yes, I would agree. There are a lot of more important things than taxes, but taxes, that's a big chunk of what comes out of your income, and you do want to take care of those appropriately and minimize them where you can. So there are a lot of decisions related to both taxes and investing and retirement that we'll cover. We'll talk about how to use different types of accounts. Hopefully, a lot of people on the call have multiple types of accounts and are curious about how to handle those in different ways at different phases of their life. Because there was a big tax law that was passed and enacted last year, we'll talk about that a little bit and the few specifics there. And finally, when we think about financial planning and retirement planning, again, it's not all about the taxes. there, your situation, your goals, your priorities are important, and we'll talk just briefly about how those interact with some of the tax decisions. So, first off, again, what are those key tax related decisions? And I know, John, you had thoughts on this one in terms of the decisions that your clients face.
Well, too, a lot of times, a question we get is, should I do pre-tax or Roth? And I know you're going to cover that. And that's whether you were in an IRA or a 401k. And we might use some of these terms interchangeably, especially when we're talking 401k. I know we've got a lot of folks that are joining us from the not-for-profit world. And so when you think of 401k, that also includes the 403b. But also, one gaining popularity, and love to hear your thoughts on it, Roger, is the health savings accounts and where that might fit into the overall equation.
Great. Yeah, we will certainly cover all of that. Yes, the Roth versus traditional, or even, when does it make sense to use, taxable kind of non-tax advantaged accounts? People at a certain point might be thinking they hear a lot about converting assets from traditional to Roth, and when does that make sense? And then how do you invest differently in the different accounts to take advantage of the tax characteristics? And along those lines, how do you take money out of those accounts in the right sequence or the right combination to fund your spending in retirement? So those are some of the things that we'll talk about. So next, we'll try and answer kind of the big picture. We'll level set everyone on what are the different characteristics of those different types of accounts and assets. So you see here we've broken it down into two big categories: the tax advantaged accounts and the taxable accounts. So up top, you see tax deferred. So again, the 401k, 403b, traditional is another way to think of that, or Roth, and as you mentioned, health savings accounts. So we call those all tax advantaged. And you can see that on all of them, as you go along, the earnings, those are deferred from a tax standpoint. But then when you get to the point of having to take money out, then there are some of those differences. And you see with a tax deferred, you'll pay an ordinary tax rate. We put that in red as kind of a signal that the ordinary tax rate is generally higher than your other tax rate for long-term capital gains and certain types of dividends. Not to say that it's bad to have tax deferred accounts, but you do need to factor in that there's going to be that tax when you take the money out, as well as for your beneficiaries or your heirs. Roth and health savings accounts have the advantage that when you take the money out, if you follow certain rules, it'll be tax free for you as well as for some of your beneficiaries. I will point out a couple things about health savings accounts. I won't probably talk about those too much more going forward. But a couple key points on HSAs. One is you'll see under contribution type that you get the benefit of those being tax deferred, so or pre-tax, kind of like a tax deferred IRA or traditional IRA, and you get the benefit at the distribution later. So you'll hear those referred to as triple tax advantaged. So from a tax standpoint, HSAs are great. If you read the fine print, or if you're in an HSA, you probably know this. There is the caveat that to do an HSA, you have to be enrolled in a high deductible health plan. So the first thing we tell people is make sure that the health insurance plan is right for you, and then you can take advantage of the HSA if that high deductible plan makes sense for you. So very important. And of course, you want to keep track of your health spending so that later on, if you're saving these for retirement, you then take advantage of all of those expenses you had for health purposes over the years. You get to take out the money even for things you occurred years ago, but after you set up the HSA. So it's a really nice feature in retirement that can give you that tax-free income when it's helpful to you. So then down below that are the taxable accounts. And we've broken it down below that not by type of account, but the type of earnings or returns that it's generating. So you have the appreciation, so the growth of a taxable account. And with that, you don't pay tax on that growth as you go, but then later you will, when you sell it, you will pay taxes on the gains. And we put that in yellow because you do pay some tax, but that tax, if you have gains, is on only the gain part of it, not the return of your basis, the return of your initial investment, and you generally get a lower tax rate than the ordinary tax rates. And then if you happen to hold that until the end of your life, you potentially get the benefit for your beneficiaries called a step up in basis, where they basically don't have to pay taxes on the gains that you had during your lifetime. There are some other types of ways that you earn money in a taxable account. So you see here ordinary income generating. So if you have money in bonds or just a taxable savings account of some sort and it generates interest, that is generally taxed at an ordinary rate. So we'll talk later about how to minimize the amount of tax hit you have there. And then there are the qualified dividends, which again pay that potentially lower rate, typically lower rate than ordinary rate. So hopefully that level sets folks for what we're going to talk about over the course of the hour here.
Yeah, it should be interesting. And I know we've had some folks join us a little bit later. So I do want to reiterate, we are recording today's session and we will be distributing that out. And then today's talk track, we should be going for about till about 1:45 for folks on the East Coast. So we want to make sure that we leave time for questions and answers at the end. And if you wouldn't mind, if you do have a question, just jotting those down into the chat feature within the Teams.
Perfect. That's great. So now again, we've level set, folks. We'll talk about those different types of investments and how to contribute there. So tax deferral, you'll hear us talk about a fair amount. And the reason that we put together this illustration here is a few years back there was an article, I think it was in Bloomberg, where someone was questioning, why have tax deferred accounts like 401ks anymore? For most people, isn't it better to put money into just a regular taxable account because you get the lower tax rate potentially on the gains, right? And I didn't love that article, so did some math on it. And the spoiler alert here is that in most cases, if you are saving for the long term, like for retirement, tax deferral through an account like a traditional 401k usually works out better than putting that money into a taxable account. And the reason for that is, again, you defer that upfront income. So you can put, say, in the example here, you put $10,000 into a tax deferred account and then you're not taxed on that piece. Whereas if you're saving in a taxable account, well, you have to account for the fact that, well, I'm not actually getting $10,000 I can put into it. If we're looking apples to apples, I'm only putting in, say, $7,800 if you're in the 22% marginal bracket. So we look at it in two different ways. On the left is an example that I think is actually fairly friendly to the taxable account in terms of the assumptions we used. Let's assume that no gains on that taxable account are taxed at all until you get to the end of the period, like 10, 20, or 30 years, say towards retirement. And your tax bracket never changes. You're always in that 22% bracket. Well, even with those favorable assumptions, you can see here and it's funny on my screen the legends are kind of tricky to see. They're a little jumbled, but the blue shows what you would have investing that $7,800 in a taxable account. The light green above it is the improvement that you would get by putting that money into a tax deferred account. So at least 8% over that 10-year period better by putting it into the tax deferred account. And on the right is an example where, well, suppose the assumptions are a little less friendly toward putting it into a taxable account, where you're getting some of that taxed every year, and you get the benefit in the tax deferred account that you were in the 22% bracket in your working years, and that actually drops down in retirement, which is a situation we often see, not always, but often, where you drop a bracket in retirement. Well, in that case, it's even more favorable toward the tax deferred account. So we'll talk about the next situation on the next page.
Yeah, and Warren Buffett called this, compound interest and growth, the eighth wonder of the world.
Hmm.
And this certainly illustrates that. And
Yes.
you've got, we've got this slide and then another slide with a couple of different scenarios. And this is a question that we get all the time, Roger. Do I
Hmm.
do pre-tax, Roth, when, why? So
Hmm.
please walk us through this.
Sure. So if you were listening carefully on that last slide, you might be thinking, well, that's great, in the situation where you might have your tax rate going down later and pre-tax makes a lot of sense. What about, situations where a Roth might make sense? And now, today in today's world, virtually all large retirement plans give you both the Roth and the pre-tax options. So it's not like years ago when not everyone had that. And you see here that there are different effects in these three phases. One is your working years. Your tax rate might be a lot higher or lower in the future. In retirement, you might be in a situation where, again, that tax rate goes down, but you might be in a situation where you've saved a lot already in your tax deferred account and you have those required minimum distributions that kick in at age 73 or 75 in the future, and that could actually increase your tax rate. And then there's the beneficiaries. If you leave them a lot of money in a tax deferred account, now because of the Secure Act a few years ago, you generally have to, as a beneficiary who receives that account, you have to take that out over a 10-year period. And so you can't stretch that over your lifetime anymore. And with that 10-year rule, well, if you're getting a big amount, well, that actually could bump you up into a higher tax bracket there as well. So there are a number of considerations for this decision, including, as we show here, what are the assets you've already accumulated? If you already have a ton of money in tax deferred, like we see with a lot of people who didn't necessarily have the Roth um, option years ago when they were starting to save. So on the next slide, we'll talk about briefly a few of the specific situations. And I won't go kind of line item by line item here, but you can see situations that could benefit from the Roth include a young person who's in a low tax bracket today, say 12%. That seems like a pretty good deal compared to the uncertainty of where tax brackets will be in the future and the likelihood that their income is going to go up. Someone, like I mentioned just a minute ago, who's already accumulated a big balance. They might have unnecessarily high RMDs. They also might have money that's going to go to a beneficiary, and maybe only one beneficiary, and that could bump that beneficiary into a higher rate. Um, and people who just can afford to save a ton of money either way, and they're not sure what their tax rates are going to look like in the future. Well, maybe Roth makes sense there. The people who benefit from a traditional are folks like the fourth row here, someone who's in probably their peak earning years now. So the example here is you're in a 32% bracket now, decent chance you might be able to take advantage of, say, the 24% bracket later or in retirement. And someone kind of the flip side of the very first one, a young person who is really tight on their cash flow and their plan offers them a match, and they're thinking, wow, I'd love to get the full match, but cash flow is tight. Well, in that case, well, you can take advantage of the pre-tax or traditional account and have a little bit more breathing room to get that full match.
And not to throw another variable into the equation, but something else to think about is from a state income tax perspective. How
Yes.
does your state that you reside in
Hmm.
view these contributions, be it a 401k or a 403b? And
Yep.
then I know I have two children that reside in what I would call low or no income tax states. And if you're in that situation, the pre-tax becomes less valuable. And
Sure.
and for those folks, Roth might make more sense. So,
Yep.
the next slide, right? And we get this all the time, right? Does it make sense to convert those pre-tax dollars to Roth? And how does that that age 59 and a half, how does that play into it, Roger?
Yeah. Well, anyone can do a Roth conversion and you pay the tax today. And the idea is you're going to reduce the taxes in the future. So you do have to make that decision. And for a lot of people, it can be, a tough pill to swallow, maybe even an emotional decision of, wow, do I really want to accelerate paying paying these taxes now? Well, here are some situations where it can make sense. One again would be people who do expect to leave an estate and they're concerned about how much tax their beneficiaries are going to pay in the future. People who can comfortably afford those taxes on the conversion and they can do it with cash on hand, or they can do it with a taxable account as opposed to having to kind of reduce the amount of conversion they're doing by paying it out of the existing Roth. So, if you have that flexibility cash wise, that makes you more likely a candidate for a conversion. If you're already well within a reasonable tax bracket, so doing the conversion isn't going to bump you into that next tax bracket, which would be kind of counterproductive. Another situation we see is, again, a lot of people didn't have a great opportunity to take advantage of Roth at good times in their lifetime, so they don't have that Roth and they want that flexibility in retirement. And the kind of key to all of it is, what do you expect the marginal rate's going to be for you or your beneficiaries? And is that higher than the rate that you pay doing the conversion? And that's easier said than done in terms of calculating. It's an area where having help from a professional really can help you, navigate all of these questions of, well, what about RMDs, required minimum distributions? What about Social Security? Another item I mentioned here. So times you might consider doing the conversion would be, you're in a low income year. So you're between jobs, but you have some money on the side to get you through it. Or, you're starting up a business, and uh, this first year of starting up the business, you have a lot of expenses and low tax rate. I had a client with a previous employer who that was really a great strategy for them. And then in retirement, you've retired and maybe your expenses are a little lower, but you haven't started claiming Social Security yet, and you haven't hit RMD age, because those can be areas where, well, once you hit those milestones, you have to have more things to take into account, and you might not have that room in a good bracket or a good marginal tax rate to do with the conversion. So doing it earlier helps you with minimizing future RMDs and potentially minimizing the tax impact of your Social Security benefits. But we could talk a long time about Social Security taxation. Maybe we'll come back to that if we have time.
Right? Can't wait for that. And I hear Irma might make an appearance in this discussion.
our our
Um,
good friend Irma, yes.
right.
Yep.
The other thing too to think about, if you are considering converting that pre-tax to a Roth, is every conversion that you do, that bucket of money has to stay in that Roth for 5 years to have that qualified distribution. I know I was working with a gentleman who was considering it, right? Moving some money from the pre-tax bucket over, but then the thought process became, okay, what if I need that money at within that 5 year time frame? What are the ramifications? So a lot of things to think about, and that's why we always say it's best to work with an advisor, with a professional that can help you ask these questions, right, that you might not think of, as well as provide those answers. So,
Great.
we're talking about the um, tax advantaged accounts, right?
Mhm.
Let's maybe turn our attention to taxable accounts, how they work, and how we might want to be thinking about taxable accounts.
Sure. And earlier when I said that for long-term purposes, it's great to use a tax advantage account like a Roth or traditional. There are certainly a lot of uses for a taxable account, and one would be if you're in the fortunate position of having more to invest than the limits on the tax advantaged accounts. Taxable account, of course, is a great way to put it. Or if you get stock from your employer, or you have a windfall of some sort, like you get an inheritance. Well, what do you do with that money? Taxable accounts, or you get a big bonus one year. So lots of reasons to use a taxable account. You just have to be careful about the tax ramifications there. So we have this concept called asset location. And the idea here is not just what does your allocation look like, such as 60% in stocks and then divided up into different stock categories and bond categories, but also where do you put those different types of investments? And I think this is getting a little more attention now. What we've laid out here is just some basic, very high level rules on where you want different types of investments to go. So with a taxable account, like we talked about earlier, you don't want to have more taxable interest income, for example. So things that you could put into a taxable account would include municipal bonds, which generally are tax free, possibly even tax free at your state level. Things like stocks and stock funds, where they don't have a lot of turnover and therefore don't generate a lot of capital gains during the year. You know, exchange traded funds typically are going to have less of that, um, that tax drag, those distributions that cause you to pay taxes each year. So ETFs can be good in a taxable account potentially. But then for the tax advantaged accounts, that is where you might want to put your higher yielding taxable bond funds, things like real estate investment trusts, um, stocks that pay dividends. All of this, of course, depends on the mix of how much you have in these different types of accounts and what's appropriate. For a Roth, we like to put very high growth potential assets in a Roth, and that could include some funds or stocks that do get traded more often and might generate those gains. So you get to get the benefit of the growth and not have to pay taxes yet on those gains. So again, depends on your situation, your trading strategy, the market environment, lots of things to go into it. But in general, this is a direction you would want to go in terms of what to put in what account.
And we're getting a lot of great questions in from the audience through the chat feature,
Okay.
and we will be addressing those. We'll, like I said, we'll leave about 15 minutes or so to answer those. So thank you to the audience for your level of engagement. Now, and again, when we're thinking about taxable accounts, right, we say nobody likes to lose money, right?
Mhm.
Completely
Yep.
understand that. However, when we're talking about a taxable account, it's not always the worst thing in the world. So maybe spend a couple minutes talking about that.
Sure. Yeah, there's this concept of tax loss harvesting. And the way I would characterize this is it can be a strategy to reduce your capital gains taxes. Um, I would say it's really helpful with tax loss harvesting to have the help of a professional. Okay. It shouldn't override sound investment strategy. You shouldn't just sell things at a loss to get the loss for tax purposes. Um, Sorry if I'm dinging here. I tried to turn that off. The you know you shouldn't just focus on the taxes only. You want to make smart investment decisions, including is it appropriate to sell this investment, right? Um, the uh, the tax technique involves being tactical about your account types. So for example, you might take your profits a little bit more quickly in a tax deferred account, but take those losses as appropriate in a taxable account. You can also use tax loss harvesting if you have kind of older mutual funds that aren't as tax efficient. And when you sell them, you can replace those with more tax efficient ones. Now, professionals doing this for people and who manage funds that are designed to be tax efficient, they're looking for these opportunities all the time. Most of you all and myself included, we don't have time to be looking for tax losses all the time, right? So it can be hard for us to do this as well as a professional can. So it can also be harder to find opportunities. We've had some pretty long stretches of bull markets where you don't necessarily have a lot of opportunities to take losses. I would say that you also want to be careful. There's this concept that is getting more popular of doing um, owning individual stocks to replicate an index. Okay, and so that kind of direct indexing concept partly relies on doing tax loss harvesting. The one caveat there is you're going to get massively long 1099 forms if you do that. And so you have to be prepared for, devoting some energy or having someone help you with your tax returns. So just some caveats here. It's a good strategy potentially, but I wouldn't oversell how applicable it is to everyone.
Great thoughts. Thank you for sharing those. And we are not accountants, nor do we give legal advice. So as Roger mentioned, you'll want to seek out the help of a professional when it comes to that. But Roger, maybe a scenario, right? Let's say I've got $10,000 in capital gains, and I've also got a corresponding loss of 15,000.
Mhm.
Can you walk through that scenario to maybe help folks understand how that might work?
Yeah, sorry, I missed the numbers you had, but you have a $15,000 loss and a
10,000
larger
in gain. 10,000 in
10,000.
gain.
Okay. Oh,
Yeah,
so a
yeah,
smaller
yeah,
gain.
yeah.
So yes, if you were to take full advantage of that loss, that $15,000 loss, and assuming it's the same type of long or short term, because there are rules around that, um, you can completely offset the gain. And then in a given year, you can take $3,000 of the loss. The excess, if you were to, in that situation, have $2,000 of excess, then that would be, then you would hold on to that for a future year. Okay, so you can use that loss carry forward in a future year. So I wouldn't say that it is something where you wouldn't necessarily do it because you can't take it all in one year, but you're not going to get it all in that year, so you would have a delay in getting the benefit from that loss.
And thank you for that. And then, you know, to this point, we've kind of focused on the accumulation phase, but it's always important, right? Folks are aging, baby boomers. We want to talk about how to convert this wealth, these assets, into income during the decumulation phase.
Yes, and we've done a ton of work on this. In fact, we actually acquired a company a few years ago that has software that is specifically designed to help people make this decision about withdrawing money tax efficiently. How do you kind of replace your paycheck with money from your accounts? And there's, even back when I was at my previous firm, we sometimes had, this kind of rule of thumb of conventional wisdom, it's sometimes called, where, well, take the money out of your taxable account first, and then when that's gone, take it out of a tax deferred account, save your Roth for the end. And it's not a crazy strategy. There's some logic to it, but we found in practice it may not be the best solution. In fact, it's often not the best solution. There's usually a better way to take money out. So, what does that look like? Next slide will give you a few principles. Um, the challenge is that this is very situation dependent on your specific situation, but in general, here are a couple of strategies that you can work with an advisor to implement. One would be, for money that you're going to use in your lifetime, you can spread out your tax deferred distribution. So even in those early years, take some money out of tax deferred, and that way it smooths it out, and you tend to stay in a low or at least reasonable tax bracket instead of that spiking you into a higher bracket later. You might also consider at certain times if your income is kind of in the lower to moderate level, still, there could be situations even for higher income people, but the possibility of taking capital gains that aren't taxed. So if you're a married couple and your total income is $100,000 or so, it's possible that even at that level, which is not low income, that you might be able to take advantage of some capital gains, kind of harvesting the gains instead of the losses, and not paying any capital gain tax on those gains. And then Roth conversions can be appropriate here. Like I mentioned earlier, that can reduce your future RMDs. It can potentially reduce the taxes that you're paying on your Social Security benefits. Now, if you're really concerned about the legacy, or you're thinking, I'm not going to run out of money, well, then you might think about, what do your beneficiary's situation look like if you're deciding whether to take money out of tax deferred or Roth distributions? Just like the decision of when to put money into one of those, you think about the relative taxes taking it out. And if you've got a very, high income beneficiary, your daughter is a CEO of some big company, that might be a situation where, you'd rather take the tax hit on the tax deferred distribution and leave your daughter with the Roth money, right? So that's an example. You might also, like I mentioned earlier, preserve some taxable assets for that step up in basis. That becomes, we'll talk about that in a minute, but that becomes more and more attractive closer to the end of your life when you have an idea of your life expectancy. And then just like with the lifetime use, there are, benefits of doing Roth conversions that can also help your beneficiaries. So again, putting all these together, there are a lot of puzzle pieces, and getting help from an advisor is really recommended for implementing these strategies.
And that's an important distinction too on the pre-tax side of a 401k or an IRA. You have the RMDs, which kick in basically at 73,
Mhm.
and you don't have those within the Roth concept. There are no RMDs. And
Yep.
something else to think about too from a legacy standpoint is, are you leaving the pre-tax side to a non-spouse beneficiary,
Yep.
right? Because we know that the rules changed around how that non-spouse beneficiary can take money out of the IRA. And so
Yeah.
maybe talk about this a little bit. Um, and I think we're going to start getting into Social Security off the next slide, which I can't wait for.
All right, great. Well, yeah, I'll go over this quickly, but the situations where you might want to hold on to some taxable investments for the step up in basis, and this might be, somewhat, you know, common sense for the most part, but if you have a large potential gain, well, then, not having to have anyone pay taxes on that, is favorable for the step up. If you are paying a high capital gains tax rate, if you're up in the 20% or essentially 23.8%, including the additional net investment income tax, then it makes it more favorable to do hold on to that asset for your step up for the beneficiaries. If you have a short life expectancy, that's a factor. Fewer years to worry about what's going to happen to that investment, for one thing, in terms of the risk level. And then the dividend rate, this one might be a little less self-explanatory, but if you have something that pays high dividends, well, you have that kind of tax drag on that over the years, and that combines with the previous point about your life expectancy. You don't if you have something with a high dividend, well, it's less attractive to hold on to it and incur that tax drag over time. But if it's a low dividend stock, for example, or stock fund, that can make a lot of sense to take advantage of the step up. So again, lots of factors to consider, not just the taxes here.
And a lot of things to think about for sure.
Hmm.
And now we've got the tax of legislation of 2025, which I
Hmm.
think for folks, particularly here in the Northeast and our clients in California, um, are particularly interested in. But maybe go through some of these key provisions, and we'll talk about which ones are permanent and which ones sunset.
Hmm. Yes, and so a lot of people were concerned prior to the passage of that law with what happens when all of these tax rates revert to pre 2020, sorry, 2017 levels. And so these things that are made permanent in quotes, of course, because nothing is necessarily permanent in the tax code, but at least we know these things are not scheduled to revert or reset. So their tax rates and brackets. The standard deduction actually went up even a little bit. The child tax credit is now even a little bit higher, and it's indexed for inflation. For people who are small business owners, that 20% qualified business income deduction has been continued. And then the estate tax exemption, which is nice in that it makes very few people subject to the estate tax. So one less thing to worry about, to be honest with you. So with that increasing to $15 million, and it's indexed for inflation going forward. So all of those, uh, you know, favorable things for a lot of taxpayers. The next slide will talk about some of the new stuff. And I won't go through it line item by line item, but there were a number of new or expanded deductions. One is for taxpayers over age 65, a $6,000 or $12,000 deduction that was in line with the president's view of trying to make Social Security untaxed. That was hard to accomplish, so they added this additional deduction. State and local taxes, we'll talk more in a second, but that's a big one for a lot of people in the listening area here, in terms of being able to now deduct $40,000 instead of a cap of 10,000. And then some more specialized ones for particular people, tip income, overtime, if you happen to buy a new American car, less likely, less common types of things. The one thing I'll point out here with the state and local taxes, if you happen to be a fortunate person whose income might be in the five to $600,000 range, the phase out of that benefit is pretty steep. And so for all of these, Congress wanted to make sure that, these aren't just giveaways to the rich, so to speak, right? So they phase out at some point of income. And you can see on the far right-hand side, second line, that if you're in that range, additional dollars of income in the five to $600,000 range are taxed pretty heavily. Instead of at the 35% rate, they're 45.5%. So what does that mean? If you're in that position, you just want to be careful about how you're funding your lifestyle with different types of income, if you're potentially in that range. And again, working with an advisor can help you to minimize the amount of income that's taxed at that very high rate. So this page just shows you something you may have already figured out with doing your taxes, your tax return in 2025. The nice benefit of that higher cap, where before, even if you had some mortgage interest and gave money to charity and had, significant state and local taxes, you might still be below the standard deduction level. And that was the case for, I think, most people. Most Americans were below the standard deduction level. Now, if you're in that position and you had some significant state taxes, state income taxes, property taxes, maybe even property taxes on a second home, all of those, now you get to take up to 40,000 of that. And the example here we show, you're going to get 19,500 more in deductions, and that at the 24% marginal rate, which kind of fits with this example, $4,680 of tax savings. So nothing to sneeze about. And you can think about that in terms of decisions like, well, when do you want to give money to charity? Do you want to bunch them in one year or another? If you're thinking about paying off your mortgage early, might have a small effect on that decision. And of course, these are all factors in the next few years before the reversion of that SALT deduction cap, which of course may or may not happen, but as of right now, it's scheduled to end in a few years.
And when we're
So,
talking state and local taxes, that includes both property taxes as well as any state or city income taxes. I know I got a lot of
mhm.
questions as we're heading into the tax filing
Yeah.
from folks. Okay, what does that really
Mhm.
entail? That kind of
Mhm.
thing.
Right. So we're coming up on 12:45, so I do want to leave time
Yep.
for questions. Just something to consider, that these decisions are not just doing the math. You do want to think about your goals and priorities. Things like health can have an impact on how you deal with tax in your lifetime. Things like long-term care expenses have a tax implication. How much the size of your family, your beneficiary situation. How important is it to you to leave a legacy versus spending more in your lifetime? How charitable are you? What's your risk tolerance? So all of these should be factored in. And as you talk, if you're working with a financial professional, talk to them about all of these and how they affect how you line things up from a tax perspective. So just a kind of quick caveat at the end. Right.
And there
So
we
quick,
have our disclosures, and we
yes.
are at 12:45, and we did want to leave time for questions and answers. So